Okay, good morning everybody. It's 11:15, so I guess we can start today. Today we will have a presentation on our initiation this morning. We initiated on CapitaLand Mall Trust. So, title of our report, Strong Operator in a Challenging Environment. I'll first go on to touch on the investment thesis we have, and then talk about some of the structural challenges facing retail landscape now. And then further to that, we'll do some company analysis. So our call for CMT for today's initiation is a neutral. Our target price is at 2.01 versus the last done price of 193. So why are we having a neutral on CMT? Our investment thesis number one is that we are expecting retail sales in Singapore to bottom in the second half of 2017, this year. And we believe so is because the economy continues to improve. And this is for some background on what is happening in Singapore in the retail landscape. We have been, over the past 3 years, retail sales has been bad, it's been dropping. Last year, retail sales overall dropped 2.6%. And that was the worst year we have seen since 2009, the GFC. So on the whole, things are looking to be bad. In the first 3 months of this year, we had the results from the various retail REITs in Singapore, CMT, FCT. They all reported drops in tenant sales as well. So it looks like the first quarter of this year, the trend is still continuing. But feedback is that the March figures are looking a lot stronger than the January and Feb figures. And January to Feb, it could be attributed to the fact that this year versus last year, there was a very much shortened shopping window period between Christmas and Chinese New Year. So that shortened window period could have taken a bit off the retail spending because of some buyers' fatigue after they finished the year-end shopping for Christmas and after all the year-end discounts. So we are expecting the retail sales to bottom in the second half of this year. And what could be another catalyst for that to happen is that sentiment could also receive a further boost with improving home prices. So now the second thesis is that investing in CMT, you're actually investing in the largest mall owner in Singapore, and with a focus on suburban malls. Suburban malls, we all know them to be more resilient than discretionary spending. So with a focus on suburban malls that are also well integrated into major transport hubs. Later I'll talk about it in the company background. You realize that the CMT's malls, they're actually enjoying near monopolistic locations. So then, if you're expecting retail sales to bottom in the second half of this year, you have a very monopolistic mall owner, why is it still neutral? So it's neutral because even on that note, there are still present structural challenges in the retail landscape. We all know that the impact of e-commerce on a lot of retail brick-and-mortar stores. In Singapore, you see a lot of brick-and-mortar stores exiting over the past few years. Over the last few years, we have seen an increasing number of e-commerce websites as well. We see a lot more aggressive promotions from these e-commerce websites, and there's also an increasing ease of shopping online. Later on, we'll touch on more for that aspect. So the second structural challenge is that in Singapore, we're actually facing a declining population growth and aging population. So these two metrics, when your population is slowing, population growth is slowing, that could actually have a negative impact, and that could actually crimp the overall retail spending. So on that note, we'll move on to talk about the company background. CMT is the largest mall owner in Singapore, 14% market share, 16 malls. And if you look at the malls, they have most of them quality malls. 75% of the malls directly integrated with MRT stations. When I say directly integrated, I mean when you exit the MRT, it is either just right on top of the MRT station, beside the MRT station, or it is linked via a sheltered walkway once you exit the MRT station. So 75% directly integrated. Those which are not, for example, Sembawang Shopping Centre, Bukit Panjang Plaza, Tampines Mall. For those of you who stay around, you should know these malls, even though they're not directly integrated with the MRT stations, they are actually just within a maximum 5 minutes walk away from the MRT stations. And I think the quality and the resilience of the malls is shown up in this metric, the occupancy rate of the portfolio for CMT. The average occupancy rate since listing in 2002 is 99%. And you see that even across the badly hit years, your SARS years, your GFC, CMT's malls have all managed to stay close to as good as 100% occupancy rate. So for GFC 2008, occupancy was going at 99.7%. The next year, 2009, 99.8%. So you see that GFC actually did not bring much of an impact in terms of occupancy rates for the portfolio. So we expect retail sales to bottom in the second half of this year as the economy continues to recover. As I mentioned, 2016 was the worst year for retail since 2009. And we see that in 3Q16, there is actually what we believe to be an inflection point in the GDP numbers. That was the quarter when we narrowly missed the technical recession. We went back to positive growth after that, and subsequent to that, we saw stronger and stronger growth. And so MTI actually forecasts Singapore's economic growth to come in at above 2.2% for this year, on the back of an improving global outlook. This forecast was made close to when the first quarter GDP was out. At the start of the year, they were forecasting a 1 to 3%. Right now, they're forecasting above 2, so it's still within the original range, but at the higher end of the original range. So, what has been driving the GDP growth since 3Q16 is actually manufacturing, exports, and particularly in the electronics and precision engineering sectors. And we're expecting this to continue because we expect strength in these sectors to continue on the back of global recovery of demand in these sectors. So a second boost for retail spending is that consumer sentiment could receive a further boost with home prices improving. First, we have to note that home prices have been declining for 14 consecutive quarters since the fourth quarter of 13, and we are expecting this to bottom at second half of 17 this year. And why is that? Why is this such an important component for sentiment and for retail spending? You see that for household balance sheets, residential properties actually make up quite a big chunks, 44% of the entire household balance sheets, and it's been staying in that ratio since historically. So given that this is such a big component of the household balance sheets, a stabilization, a bottoming in home prices will actually do much to improve sentiment. So over the past 2 years, we've seen that household balance sheets have been improving as well. Total gearing has been dropping over the past 2 years. So we see that in 1Q17, the government went on to its first easing of property cooling measures. That has actually done much to improve sentiment. Our rationale for expecting a bottoming and improvement in home prices in the second half of this year stems from, firstly, after 14 consecutive quarters of home price fall, affordability actually has improved. And the buying sentiment would likely have been improved as well after the government's easing of the measures in first Q17. So that is on the demand side. On the supply side, we see that unsold inventory from developers is actually dwindling as well. This is a result of the tapering of the government land sales since 2011. So with that tapering of government land sales since 2011, you can very accurately predict that over the next few years, the launches from all these government land sales will taper off accordingly as well. And so you see that on the demand side, it's likely to improve or be supported because of better sentiment, but on the supply side, it's actually dwindling. So we see that in the first Q of this year, transaction volumes have increased 70% year on year. And our talks and our channel checks with developers, they also seem to point to a greater hunger for land amidst most of the developers. And I think we have seen that on the ground as well with 4 en bloc sales over the last month. So it would seem as though the developers, they are sharing the same optimism on home prices. And we do a historical check on retail sales versus home prices, the correlation. Since 1985, there have been a total of 9 years of retail sales decline, 9 years, and most of them, 7 out of 9 of them have occurred in years where your property prices were dropping as well. So from this, we can conclude or we defer that the home prices are actually very important for sentiment and for consumption as well. So on top of CMT's very well integrated, very well located suburban malls, and then near monopolistic locations, we see CMT as a proactive and innovative operator who are very embracing technology, very embracing innovative solutions to improve shopper experience and for better operational efficiency, which is very important now, especially in face of the threat of e-commerce. You have to make sure that malls are just not places for people to go and buy stuff, but for people to hang out. It's a more wholesome experience now. So this particular aspect will be very important, especially now. And so this the good part, the well-located malls and these proactive approaches, how do we back them up in terms of numbers? We see that consistently CMT's malls have been able to maintain a near full portfolio occupancy. And so we talked about the measures that they have been trying to implement for better operational efficiency in the malls to improve the shopping experience generally. So some of the measures they have done include the partnering with the Philips lighting department to actually install light bulbs or lighting fixtures in malls which are equipped with this visible light communication technology, which enables the frequency of the lights emitted to be captured on the phone, on the shopper's mobile phones, and that capturing actually allows the mall to detect the locations of the shoppers. And by detecting the locations of your shoppers, you're actually able to send out, for instance, more targeted, more personalized marketing messages. And for instance, let's say if I'm on the 2nd floor near to the Adidas shop, or near to a particular shop that's having some promotions, then a notification can be sent to me to inform me that, oh, hey, you're just 2 steps away from getting 30% off store-wide from Adidas. And this is on top of the data that they could potentially already collect on their Capital Star app, which is launched with a full slew of automated AI chatbot, which is able to dish out a slew of concierge services. So shoppers can use the app to do restaurant booking across all the CMT malls. You can do ride-hailing bookings from the app as well when you are done with shopping in the malls. So a third thing that they are doing is the streamlining of the goods delivery process for the tenants through the harnessing of technology. So that process has actually shrank delivery time by more than 70%. So it's good for tenants that want it straightforward. It's good for shoppers as well if you can clear up the clutter of traffic around the malls occupied by delivery trucks and all that. Then it indirectly improves the shopping experience for shoppers as well. So like I've mentioned, all these measures, all these good points, and good location and monopolistic locations and approaches that they are doing, how does it translate to the number that is close to investors? Is that the number we'll be most concerned about will be occupancy rates for the portfolio, and you see that historically, through the good years, through bad years, they've been able to maintain their occupancy for the entire portfolio at close to 100% mark, which is outperforming the general island-wide occupancy rate as well. So, given that strong performance of the malls historically, if an investor had invested in the shares since IPO, the CAGR growth for the shares would have been 6.1%, and I think the strong numbers are also reflected in the valuations for CMT's malls as well. The three malls that they have since the IPO, Tampines Mall, Junction 8, Funan, the CAGR growth for the valuations for these malls have also outperformed. If you compare them with, let's say, the private residential property price index, that one, the CAGR is 3.7%. If you compare that with the price index for general shop space in the central area in Singapore, that's just done at 1.7%. Fringe area would have done 2.1%. So you see that all in, because of the measures they have implemented, the locations the malls are in, the operator is able to maximize the income earning ability of the malls, and that actually translates to a higher CAGR growth for the CMT shares and the malls itself. But historically speaking, that is the case. Going forward, will they be able to replicate the strong performance? We think it may be difficult, because right now retail landscape, you are facing very, very tough headwinds, and that is something even the strongest operator may find hard to avoid. So what are some of these structural challenges we're facing? E-commerce challenge, the headwind from that aspect is something we are all very aware of. According to Visa, 2015 statistics, for Visa in that year, for fashion-related online spend, that has actually grown at 35%. And if you compare that number with CMT malls, the fashion, shoes, and bags category, that is the closest category we can find to the category that Visa has grown 35% for. CMT malls have done a positive 5.5% that year. So even though it's still very much lower than the online spend, it's outperformed the general island-wide negative 2.7% for the wearing apparel and the footwear category. So a lot of this outperformance could be because a lot of retail spend is being diverted to all these overseas e-commerce websites. You buy from ASOS, you buy from Amazon. These are the retail spend that are not tracked by the Singapore Stats Board. The Stats Board, this negative 2.7%, will track the tenants in Singapore, including what they sell online, but not overseas websites. So one of the studies done by Temasek and Google is also forecasting for the e-commerce market in Singapore to be worth 5.4 billion by 10 years from now, versus the 1 billion right now. So if that comes true, that's actually a CAGR of about 18.4% over the next 10 years. Vastly ahead of what we have seen historically over the past 10 years for overall retail spending. That was just up 2.7%. So we think that online shopping still has much room to grow in Singapore. Why is that so? Because right now we see online shopping at a 2.1% of total retail sales. You have the ratio for mature countries. If you look at US, UK, this number is usually upwards of 10%. So what are some of the catalysts that can actually bring more spending, retail spending, into the online space? First, we know that Amazon is coming into Singapore in the second half of this year. And we know that nowadays we see a lot more e-commerce websites, a lot more blog sites selling fashion stuffs. A lot of these e-commerce players are actually coming up with very aggressive promotions. as they vie for market share. You see that this is a recent tie-up between Alibaba, Netflix, and Uber. And in this promotion, you sign up for this membership program, which is at just $28 per year. You actually get expedited deliveries when you buy on Taobao, you buy on Lazada. You get 6 months, you get free Netflix subscriptions, you get discounts off your Uber rides as well. And then you see that the RedMart has actually come up with this price match guarantee as well. So anything you can find in NTUC, in Cold Storage, Sheng Siong that is selling at lower price than RedMart, they will gladly refund the difference to you. So all this aggressive promotions by e-commerce players will just serve to bring more retail spending into the online space, and that will just heap more pressure on brick-and-mortar stores. Another point that is likely to facilitate the shift of more retail spending into the online space is due to the improvements in logistics and last-mile deliveries. Over the last few years, we've seen startups trying to come into this space to disrupt and to bring about better efficiencies in that space. And we've seen that generally over the years, when you buy something online, the delivery process, the pickup process has just gotten so much easier. Nowadays, there are a variety of collection points. You can go to 7-Eleven to collect your stuff. You can pop by any of those Singpost pop stations to collect your deliveries. And so this will likely increase the ease of e-commerce, of people shopping online as well, and lower the obstacle for people to go and buy something online versus if you go and buy personally at the brick-and-mortar stores. A McKinsey study in 2016 actually predicted the future of e-commerce to be dominated by autonomous vehicles as well, delivering 80% of parcels, and they opined that this could happen within the next 10 years. So with this development, shipping time for e-commerce deliveries will set to shrink even further. So on the back of all these reasons, we expect online sales to gather momentum, to continue the strong momentum and account for a bigger portion of total retail sales in Singapore. So as a result, brick-and-mortar stores will continue to remain under pressure. So operators really will have to up their game and improve the overall shopping experience for shoppers in the malls and establish these malls as venues for people to hang out and not just for people to go there buy stuffs. So a second structural challenge that we are seeing in Singapore is that we are actually facing a population growth rate that is slowing versus historically. We saw that the last white paper issued by the government, the forecasting of a population number of 6.9 million by 2030, that number, if materializes, will imply a CAGR of 1.5% from now to 2030. So this 1.5% CAGR actually pales in comparison. It's actually a slower rate if you compare with the last 10 years that we've done. We've done about 2.5% in the last 10 years. Last 30 years, 2.4%. But the last 30 years, 2.4%, primarily in the first 15 years, growth was actually stronger, and then subsequently, as we became more dense, we became more mature, growth rates were slowing down. And over the next 10 years, we can expect even slower population growth rate. So on that note, slowing population growth rate will actually then have a negative impact on the total retail spend in the country. And we all know that Singapore, not just Singapore, a lot of Asian countries as well, we are actually aging rapidly. We are seeing that the red line is the old age dependency ratio that's actually rising and will be expected to rise further going forward. As the dependency ratio goes up, you can also expect that possibly retail spending could be negatively impacted as well. So next we go on to talk about a bit about the upcoming supply across the island. We see that from now until 2020, we have about 3 million square feet of retail space coming up. Major projects are shown here. You can see that a lot of these major projects are coming out in the eastern region of Singapore. You have Singapore Centre, you have Paya Lebar Quarter, Jewel as well. These three combined, all in the eastern region, are going to add close to 1 million square feet in the eastern region of Singapore. That is like a Vivo city adding a Vivo city in the next 2-3 years. So because of this, we expect the rental index, especially in the fringe area, to continue to be under pressure because majority of supply over the next few years will be concentrated in suburban areas and particularly in the east as well. So I'll pass on to Peter to talk about the company dynamics and analysis.
Morning, everyone. Peter here. So we will go more micro, more in depth about what was really going on in the company. But at the same time, I understand that CMT comes to be no stranger for everyone. I'm quite sure that most of you are actually aware of what's really going on with the company. But I will just give an update about its more recent happening. So we'll start off by looking at tenant sales. So CMT's tenant sales and Singapore retail sales, when I do a comparison in terms of their growth rate. So if you pay attention to the chart over here, blue line is CMT, red line is the Singapore retail sales as a whole. Tenant sales in CMT continues to outperform. You can see the white space over here. So it continues to outperform, and this is attributed to two reasons. First thing first is the high base of shoppers traffic. And shoppers traffic is important to look into because higher footfall means that there is a higher percentage for conversion of sales. So in other words, think about it from this point of view. If no one visits the mall, there'll be no sales generated for tenants. And why is this important? Because this is fuel, or tenant sales is a fuel for rental income. So at this point of time, shoppers traffic remains good, and this is because of the well locality of the shopping mall. So like my colleague De Hong has shared, 75% of the malls, they are directly connected to the MRT station. So it's good locality of the mall attracts good shoppers traffic. The second reason is that the majority of the sales come from necessity spending, and necessity spending is less susceptible to the general economic environment. So it goes without saying, necessity spending goes towards like things like groceries or eating and things like that. So it's less susceptible, and it's less impactful when it comes to when it comes to impact from the economic environment. Excuse me. So, but one thing that we have to get real and we have to face reality is that retail sales, regardless of whether it's Singapore retail sales or CMT, it's coming down, and this trend is expected to continue. And the sole reason behind it is because of the structural change in the retail landscape, which was touched on earlier. Next, okay, just a quick recap. For a REIT, there's really two main ways of growing. First is I've broken down into organic and inorganic growth. So when it comes to organic growth, of course, it's rental reversions. That's the fundamental way of growing. So more rental income, more distribution, and that translates to more value for unit holders. And second way of doing so is through AEIs. AEI, or in other words, asset enhancement initiatives. So layman terms is actually renovation. So through that, they can either open up more space for rent, or they can refresh the mall and hope that it will bring more people, and then they will be able to augment for higher rental. And the third way of growing is through inorganic growth. That is through an asset acquisition. So more asset under its portfolio means more rental income. So now the first thing to look at is the rental reversions. So in terms of rental reversions, I won't walk everyone down, but just look at these two charts over here. So how to make sense of these two charts is that first thing first is look at CMT's occupancy cost. Oh, okay. Before that, so we are doing a comparison between CMT and FCT, which is Fraser's Centrepoint Trust. So blue line CMT, red line FCT. So in the last 4 years, occupancy cost for CMT has grown from 16% to 19% today. So it is much higher compared to FCT, and the impact over here is that means that there will be when occupancy cost is higher, it means that there is also lesser room to squeeze tenants for rental. And it's apparent over here when you look at the second chart. You can see a divergence in terms of rental reversions. For CMT wise, again the blue line, for the past 3 years it's been coming down, and for FCT it's been growing, especially in the past 1 year or so. So you can expect this trend to continue, and again, higher occupancy cost translates to lesser room for REIT to negotiate for higher rentals. So now when it comes to another way of growing, it's which I just shared on, is the inorganic growth portion, which is acquiring another asset. At this point of time, CMT has a gearing ratio of about 35% or so, which translates to a current debt headroom about $840 million. And take note that this includes the redevelopment cost for Funan. So they are currently doing redevelopment works there. So I will touch on more on these later. But the key figure to pay attention over here is the $840 million in debt headroom for CMT. And this means that it can probably acquire another shopping mall. And if you look at the 4 properties here, which is currently being held by a sponsor, Capital Malls Asia, there are 4 properties. So first one is Jewel, which is $746 million. But nonetheless, this valuation is not representative of the property, simply because at this point of time it's currently under construction, which means that valuation is expected to go up more. And with $840 million, there's just really not too much room to just really finance the whole purchase from debt. So the next 3 properties, the more likely one that can be acquired, Star Vista, is about $276 million. So well, they can do that, but let's not forget that if you look at in terms of this gross floor area, it's about 24,000 square meters. So this means that this is one of the smallest malls within the 4 assets, minus away Ion Orchard Link, which is essentially just an underground passage. So the three assets that they can really acquire is just these 3: Jewel, Star Vista, and Ion Orchard. So out of these 3 malls, Star Vista, which is the one that fits its budget, is the smallest one. So which means that it is unlikely to be a kicker to its current portfolio. Next, the last one is we are talking about is AEI, and for CMT is no stranger when it comes to doing AEIs. It's been doing it for if you just look at the past 3 years, its track record, it's about 2 or 3 properties that undergo AEI works that have been completed within the past 3 years. So at least 2 or 3 of them. And at this point of time, they are currently doing redevelopment works over at Funan, and as well as AEI works at Raffles City. So Funan's redevelopment work is expected to finish in the 4th quarter of 2019, and which means that the earliest contribution from Funan will come in FY20, or that is essentially 3 years later. So for Raffles City, its AEI works is expected to finish in the 1st quarter of 2018. Okay. Well, now let's look into the redevelopment works and AEI of Raffles City. So we start with Funan first. Funan, the property has been torn down, and it's currently, like I said, it's being redeveloped. So the new property will be an integrated development which has 3 components. So retail, office, and service residence component. So what is different between this property and the previous Funan Mall is of course the that I've just mentioned. It becomes a integrated development. And second thing is that these improved connectivity is actually improved because previously there was no underground passage which connects the City Hall MRT to the new development. At least right now they're constructing it, which means that next time round, patrons can actually just access the mall via this underground passage. So improved connectivity is more likely to attract higher shopper traffic. So now let's look in terms of its number. The previous Funan development's net lettable area was 300,000 square feet before it was put down. So after its completion, new property will double its net lettable area to 600,000 square feet. So with an estimated redevelopment cost of $560 million, this means that the asset will be able to bring about $36.6 million in net property income per annum. And if you matched it against the total MPI in 2016, it represents about 8%. So this $36.6 million in net property income is 8% of 2016's. Now, next is the AEI works at Raffles City. So the thing to take away here is the AEI works at Raffles City is primarily superficial. So this means that it will not be a direct booster to the mall's rental income. And the thing to note is that the primary objective of doing so is to refresh and keep the mall relevant to the evolving trends. So it is to rejuvenate the mall and to bring in more shoppers traffic. Next is the risk to our TC. So in terms of upside, the upside risk over here is whether would there be stronger than expected economic growth and the employment situation in Singapore. And this means that it will be able to lead to stronger pickup in retail spending. And the second point is that whether would there be a slower than expected rate hike over in the US. So a longer low interest rate environment will benefit not just CMT but the REIT sector as a whole. And the downside over here is it's the opposite of the upside factor, which is whether there be weaker than expected employment and housing market in Singapore, which affects sentiment and of course retail spending. Next is the opposite of the second point is whether there be a faster rate hike. And this means that if there's a quicker rate hike than expected, how this impact REITs is not just CMTs, it increases the cost of borrowing, and it will lower the appeal of yield instruments where REITs fall under. So last but not least is valuation. So we once again we've initiated with a neutral, followed with a DDM target price of $2.01. So at this point of time, dividend yield is on the high side, matched by a price to book, which is on the low side. So it definitely warrants an investor to put inside a watch list to monitor. And finally, we reiterate our call on REITs. We maintain an underweight rating where we have 3 retail REITs under our coverage now. So CapitaLand Mall Trust, Fraser Centrepoint Trust, as well as CRCT, which are all at neutral. And finally is three key points for you to take away. So first thing first is in terms of investment TCs, we expect retail sales to bottom in 2H17, and the primary reason behind is because of the economic environment continues to recover, and CMT the largest mall owner in Singapore, and it has a focus on suburban malls that is well integrated with major transport hubs as well as near monopolistic locations. So structural challenges wise, we talk about the e-commerce sites as well as them being more aggressive in their promotions, creating competition for brick and mortar stores, and of course the declining population growth and aging population in Singapore. So when we look at the company in that, the problem that CMT is facing now is rising occupancy costs. Right now it's at the highest at 19%, and we can expect pressures in rental reversion moving forward. And with that, we've come to the end of the webinar, so we'll open the floor for Q&A. Thank you.
Hi, morning guys, Teh Hong here. There is a question on FCT and the North Point AEI. So we know that the North Point AEI is ongoing. So question is, when will the AEIs at North Point start to contribute towards the DPU? So companies forecast, and as of last results, the forecast is for the AEI to complete in September this year. As of the last results, they are still on track to finish all the renovation works by September this year.
Hi, Peter here. I got a question on what is occupancy cost as well as the how does it compare with its competitors like FCT and Star Hill REIT. So first thing first is, wow, let me just go back to the slide on occupancy cost. So occupancy cost, how it's measured is the rental being charged to a tenant divided by the total sales of a tenant. So what it means is that the higher the percentage the more rental that they can, or essentially the more rental that sorry, let me let me rephrase what I want to say. So the higher the percentage, it means that the affordability of rental is actually reduced. So how it compares with FCT is CMT is 19%, yes, and FCT at this point of time is about 16%. So again, like I said, the higher percentage, which means that the affordability of rental is actually reduced. So in this case, for FCT, because of its lower occupancy cost, that's why you're able to see a higher rental reversion here. Why is it so? Because its tenants are able to afford a bit more. So it makes sense for the REIT to actually squeeze out a bit more rental income here. So next is okay. I mean I'm done with FCT and CMT. But when it comes to Starhue REIT, two things to mention here first. First thing to note is that Starhue also has offices as well as an overseas property. So it's not a good comparison on a portfolio basis. And the next thing is that even if you look at its more component, Starhue is more of a luxury spend. If you try to look at the or try to assess its tenants, the luxury brands are there. Like I mean, it goes to no surprises. LV brands like these are there. So henceforth, it's not a good comparison compared to like say for example, a mall operator like CMT, where most of its spending comes from necessity spending. About 80% or so comes from it.
Hi, Tong here again. Question is on generally on retail REITs. What is our top pick for retail REITs? So right now, as Peter has shown you the table, as you can tell from our ratings, we are generally adopting a neutral underweight kind of stand on retail REITs in Singapore, and as well as the CapitaLand Retail China Trust is on neutral as well. Why are we on a neutral for retail REITs? Is because generally I think the headwinds that these operators are facing is going to be here for a long time. At current valuations, I think is a fair price to pay. So all these headwinds, I only expect these headwinds to get stronger, because you can see, like I mentioned in my earlier slide, that a lot of these e-commerce players, they're actually upping their game. They're increasing the aggression of their promotions very, very aggressively. Just last week, I bought this something on Lazada, and delivery was supposed to be on the same day. So it's a one day delivery. So now you buy online, you don't have to wait 1 week or a few days. So that 1 week, 1 day delivery, actually they delivered it the next day. And I did not complain, but they came back with a sorry and apology email and a $12 $12 voucher for me to use. And this is on top of the fact that the item I was purchasing would have cost me about easily 30 or 40% more if I were to go to the bottle of perfume would have easily cost me like 30-40% more if I had gone to Sephora and Suntec City, for example. That is just one of the measures. Like we saw in the earlier slide for Weedmart as well. And the price match guarantee, like if there's a price match guarantee, maybe I wouldn't want to buy groceries on Weedmart. I want to choose my groceries myself. But for other stuff, let's say I want to buy Milo, I can just get them on Weedmart. So that is one. Improving logistics is another one. And so for Starhue, is more of a tourism play, and not now. Perhaps the government is very actively trying to revamp Orchard Route, but it's going to be a long process. It's going to be a smooth process. Going forward, there may be potential, but right now I think we don't have official coverage on that. So I think in the interim, as all these mall operators, they try to up their game, improve the shopper experience, try to improve all this O2O, online to offline or offline to online kind of initiatives. It will take them time to adapt. It will take them time to implement all these measures. In the interim, while they are implementing all these measures, there will be a slack. There will be a downtime, I think. But in the retail space, we actually have an accumulate on Croatia's, though it's not so much about exposure to Singapore, but it's about the Japanese retail scene. So that one we have an accumulate. Okay, there's a question on question I think is pertaining to this risk that we mentioned, that is okay, this faster Fed rate hikes than expected, increasing the cost of borrowing for CMT as well as lowering the appeal of new instruments. So question is what are these new instruments that we are talking about? These new instruments we're talking about is actually the REITs that in general. Because in general, I think investors, they buy REITs for stable passive income, for the dividend yield. So as a whole, if you see that the interest rates are rising, you have higher interest rates on your, let's say your bonds, you have higher interest rates on your 10-year treasuries, you have higher interest rates on your fixed deposits. These instruments will actually compete with REITs as an investment asset class, and which is why very often when measuring a REIT, we will actually use the REIT's spread over the 10-year Singapore government bond and use that as an assessment of how compelling or how appealing the spread is at the current moment. So you see that when interest rates go up, not just do they affect the borrowing costs for REITs, on the broader view, if you look at it as an asset class on a bigger picture view, the higher interest rates will actually mean that investors will have more choices outside of REITs to invest in that can give them a sufficient kind of return or kind of dividend or yield. So that will actually bring down the appeal of REITs if their DPU does not go up accordingly as well. Okay, I do not see any further questions. If there are no further questions, then I think I'll bring to an end this week's webinar. So thanks everybody for attending, and we hope to see you guys again next week.